So apart from unit trust, if you're looking at a more fixed term, fixed interest rate kind of investment kind of product, obviously unit trust is an option. But I would also want to highlight that equities, share market, should be more attractive, to be honest, given that interest rates have started to come down, right? So given that now interest rates are very low, you're getting impacted by taxes, I would suggest that you start allocating a little bit more towards investing in the share market as well, right? You can start by investing in slightly less riskier shares. Go for the blue chip companies. They're hugely undervalued right now. And normally what we've seen in the past is that when interest rates come down, markets go up, or the share market goes up, and vice versa, right? So there is a negative correlation between interest rates and the equity market, right? So when interest rates come down, equity markets go up. And similarly, when interest rates go up, the equity market comes down, right? So with interest rates now starting to come down, your equity market should ideally start to perform well, right? Why? Because when you look at your deposits and so on, which are the large component of the investment universe, now when returns are very low, they are unable to cover up for inflation after taxes, people are looking at alternative asset classes, right? And equities, because if it's cheap, you'll see people coming in more towards the equity market. So still, the equity market hasn't started adjusting, which is where the opportunity is right now. And going into 2024, we feel that allocation from a portfolio perspective, equity should be overweighted compared to what we were doing over the last 2 years, right? And why I say market cap or the equity market is cheap right now is if you look at inflation adjusted market cap from where the market was before to where the market is right now, the yellow line shows where the market is. If you are inflation adjusting it right now, it's at a huge discount compared to where it was, right? So the market hasn't moved in line with the inflation and so on, right? So normally what happens in other markets when inflation prevails is the equity market also kind of adjusts, right? Because companies reprice their pricing, right? So company profits also change, and also that reflects in terms of the market cap of the companies going up, right? But this hasn't happened, which is why the yellow line, which is where the inflation adjusted market cap is right now, is way lower compared to what it should be in the current context, right? So market is very cheap right now. If you look at the trailing multiple of the market, it's at about 11 times price to earnings multiple. You might think it's high, but the thing is it's on a trailing 12 months, which is reflecting very low earnings, which were reported last year, right? So with corporate profits going up in the second half of this year, you will see these numbers starting to adjust, right? We still have companies which are low single digits, and this will improve when corporate earnings or companies start showing more profits going into the second half of 2024. And why we say company profits will go up is A, because a lot of the companies have a lot of debt, right? And this debt is now reducing in terms of cost because of interest rates have come down. So a lot of the leveraged companies will see a reduction in terms of their cost of funding. Second is that consumption will start booming, right? So at the moment, things are very weak, but it will change. It will start picking up in going into second half of the year. And keep in mind, this is driven by credit becoming cheaper, right? People have been waiting and watching and postponing consumption. That will change. The government has a little bit more leeway in terms of cutting down taxes a little bit going into the second half. And also from the perspective of tourism and so on, we are in a very good position, which will also add to the economy in the second half of this year in a big way, right? So all of this will contribute to improve economic conditions going into 2024, unless there are any black swan events which could derail us from our path, right? So a lot of the people have questions in terms of whether Sri Lanka will have another problem in terms of domestic debt restructuring. What will happen then? Will we fall away from the IMF program? So my view is that Sri Lanka is unlikely to go into a second domestic debt restructure, given the current improvement that we are seeing on a fiscal position, right? So our tax collections are improving, right? So even though it has taken a toll on the economy, the tax collections have gone up, which is improving our primary deficit, which is revenue minus your cost of the government, has substantially improved. And we're seeing this after 20, 30 years of having a large part of our deficits under primary on negative territory. Now we are in a positive stage, which means that the government's borrowing requirement will gradually come down in the next couple of years, right? So the debt to GDP is reducing right now, right? Which means that that overall debt position improving will mean that we don't have to be worried about debt need to be restructured again going into the next 2 years, unless Sri Lanka deviates too much from a fiscal perspective, where they suddenly increase expenses, cut down on taxes substantially. We don't think that there is a real need for another domestic debt restructure as such, right? So you must be also thinking, okay, we're saying that government can cut down expenses or going to cut down taxes a little bit, but can they really do that, right? But if you look at the numbers coming in, the first half, the government is collecting a bit more in terms of the tax revenue collections. And the good news is that they are reducing the expenditure. And most likely what they're going to do is offload a large part of the expenditure towards the second half, towards closer to the elections, to kind of fuel consumption coming in, right? So this, without affecting the overall fiscal deficit of the country, can result in more consumption coming in the second half of this year. Okay. And normally, loan growth in the banking sector and the growth in terms of the equity market have a very positive correlation with a one-year lag, right? So if credit has now started to grow, which means that in the subsequent, towards the second half of the year, that should also mean that your share market will also start moving up, right? And credit, I think last month, the banks lent about close to 100 billion rupees in terms of loans. And this is a significant increase compared to what we were doing before, right? So why loan growth matters is that loan growth is what kind of leads to economic activity. And when economic activity moves, you're going to see that reflecting in corporate earnings, and corporate earnings improving means that your share market investment should do well, right? So compared to before or the previous sessions, I'm giving a little bit more emphasis on the equity market because I feel that with interest rates coming down, there is a good opportunity, a good opportunity for equities to outperform in 2024, right? Despite a lot of the political risk and so on being factored in, my belief is that Sri Lanka is unlikely to deviate from the IMF program, given where we stand right now, irrespective of which political party comes into play. So we will have this fiscal discipline going in for the next 2-3 years, which will mean that if we have these reform agendas happening, Sri Lankan equity market should do well in the next 2 years, particularly with interest rates going to be remaining very low. Right. So the good news is that equities, from a taxation perspective, is very efficient, right? So compared to fixed deposits or any fixed income investment where you pay 36% if you're falling into the higher tax rate, equities is completely free from capital gains tax. So you only have to pay a 15% tax on your withholding tax on dividends. If not for that, there is no major taxation on equities, which makes it an even more compelling proposition for investments going into 2024. Right? So with the IRD kind of really going in terms of income tax collections and so on, avoiding taxation on fixed income investments will also become very difficult. Right? So you might have to pay your taxes on your fixed income investments, which will mean that your after-tax returns are going to be very bad on fixed income investments, which will make it more attractive for investors to look at equities as a more compelling asset class, right? So the good thing is that from a taxation perspective, equity will be only subject to a 15% dividend tax. Apart from that, there's not going to be any tax. And what we feel is that sometimes you can replicate your fixed income investments through equities as well, right? And you can do that if you invest in dividend yielding companies, right? So I was looking at a few options, and these are not a comprehensive list, but some of the decent, more less volatile companies, their gross dividend yields range between 8 to 14%, right? And from a net dividend yield perspective, after factoring this 14% tax, a lot of these yields will be between 7 to 12%, right? And so it's on a after tax perspective also, these equity numbers are looking better compared to the after tax return that you're going to get on FD, right? So if FDs are giving only 9% and you pay 36% on it, you're only getting 5.8% return, right? But in terms of equities, your after tax returns, if you're going for these dividend yielding counters, will be north of 7.5 to going up to even 11-12%, right? So there are more companies. Actually, I think there's about 25 companies for last year have been able to maintain a dividend yield which is in excess of 8 or 9%, right? So there's opportunity to kind of capitalize, and you're replicating a fixed product, a fixed income product through equities. And these companies are more stable in terms of share prices, which allows you to kind of make an additional capital gain if the share prices also move, right? So you'll get the minimum return from your dividends, and also you can kind of make a higher return if you make capital gains returns, and if the share market also starts moving up, right? So possible catalyst for the upward market movement, equity market movement, is definitely the key driving force will be falling interest rates. Second one will be the completion of the external debt restructure. And we very strongly feel that by June, we will have an announcement coming in. And it's most likely going to be between a haircut of 20-30% in terms of face value, which will mean that you're looking at a 50% loss for the sovereign bond holders. And that's likely more likely to go through in the second quarter of this year. The tax benefit of the equity investments also will be a positive for equity investments. And the other big one will be completion of some of these state-owned enterprises sales. If these state-owned enterprises are sold to a lot of these foreigners who are bidding for them, there's a lot of dollar inflows that will come into the country, and which means that the central bank can also buy these dollars and put rupee liquidity to the system, which will improve the overall rupee float in the system, which will flow into low interest rates and also the equity market in a larger perspective. Also, looking at past historical relationships, the governments always used to spend heavily ahead of election cycle, right? So even though first quarter has been slow, we feel that spending from a government perspective will kick in the second quarter ahead of the election cycle. And with the improvement that we will see on corporate earnings with the economic revival, we will see that the market earnings will improve, and that driving the equity market as well. So the market, which is at 11 times or so in terms of price to earnings multiple, will fall to about 8-9 times, right? Once the earnings start kicking in terms of performance. Right? So some interesting statistics. Now, people say that elections are a key driver in terms of spending and for equity markets. I've just put some data what I found from past election cycles in Sri Lanka. So if you look at Sri Lankan presidential elections from 1982 to now, out of 8 presidential elections, 6 of them, the government's spend as a percentage of GDP has increased compared to the previous year in 6 out of the 8 presidential election cycles, right? So governments tend to go and spend all out, particularly closer to the elections, to kind of stimulate growth and for the public to see the things that they are doing in terms of an economic front, right? So we are cautious on what it can do for the currency. This is why we are saying that currency can depreciate a bit more. But from a growth perspective, the fiscal stimulus will come into play, and monetary stimulus, the central bank will kind of more take a backseat in terms of making no more policy changes going into second half of 2024. And also from looking at how the share market has performed in the last 6 presidential elections, I've just looked calendar year returns. Out of 6 presidential elections, in 5 of them, the returns of the market has been positive, right? Even though the 2015 elections, I've just taken 2014 as a year because elections in 2015 happened on January 9. So a lot of the work actually took place in 2014, or spending and the markets rose in anticipation of the presidential elections. So normal tendency is that leading up to an election, 6 months ahead of election, markets tend to kind of run, and that's because of economy seeing slight bit of benefit with fiscal stimulus coming into play. Right? And this election phenomenon is not just a Sri Lankan one, right? So world over, you're seeing ahead of presidential election or political cycles, there is a bit of spend and markets tend to kind of do very well. So even in the US, the S&P 500 has provided a positive return 20 out of 24 times in a year of elections. Right? So we believe that going into this year, we will see some kind of spending coming from the government. The benefits of the monetary policy easing will come into play by the second half, and that will drive the market also, adding support to the benefit that we'll get from the lower interest rates. Right. So how do you invest in equities? There's two approaches, right? So you can be active in terms of market, buy your shares by yourself, open an account with us. You can even trade online, or if you're a larger client, we can onboard you with a stockbroker. So this will need a bit more effort in terms of picking the stocks, which our research will obviously help you, or Cal research will obviously help you in terms of picking the stocks if you're following us. If not, you also have the option of choosing our unit trust product, which is taking passive exposure to our equity fund, right? So a passive exposure to the equity market through what we call as a Cal quantitative equity fund, which is a fund which has existed for almost a decade now. If you don't have the time and energy to research on companies and actively trade in the market, your best option is to go for investing it through the equity fund, because the fund managers here will do the work for you. They will do the research. They will pick companies for you and pool investments and invest it on behalf of you. So if you take a passive approach, like what I said, the Cal quantitative equity fund is a means to the way of getting to taking exposure to equities. So this particular fund that I'm talking about has 4 billion rupees under management. Last year, the fund gave a return of 36.6%, when the all share price index only moved by 25.5%. And if you look at our fund since inception, I think that was in 2013, we've given a compound annual growth compounded by at least 13% since inception, right? So this has outbeaten fixed deposits and also your overall equity market. We've outperformed the market, and as what I'm showing in the graph, that's how our portfolio, the quantitative equity fund portfolio, has performed compared to the market starting from 2020.